What's going on, guys? In this video, I wanted to go over something really important that I think is going to be hopefully very positive for all you guys. I want to address what's going on in the market, kind of explain at least my opinion on what's happening, and then also my opinion on how you should basically treat the market going forward. There's a lot of kind of speculation out there, a lot of things kind of going on. And we want to take a look at kind of how some successful investors have looked at the market and why that's important for you to look at the market in a similar way. So I hope you enjoy the video. If you do, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. So as always, let's take a look at SPY. So overall, the S&P 500 is up almost 4.5% over the last 5 days. Today, we had a 1% move up, which has overall kind of been positive, and that's really come on the back of Apple's earnings. So Apple crushed earnings. I kind of predicted that they would in my video last Wednesday, and they ended up coming through and basically crushing earnings and showing a lot of guidance forward in a positive direction. So overall, that's not what this video is about, but basically we can see that the market's kind of gone up now over the last week, but we've had a lot of kind of jumping around, and this isn't even kind of showing that obviously the market's very weighted to the upside. There's a lot of large companies. You've got Google, Apple, Amazon, Microsoft, all these kind of large companies that are holding the stock market up right now. But as individual investors and people who pick individual stocks, you're probably exposed to a lot of smaller companies as well. And a lot of those smaller companies have been getting beaten down. So I want to take a look here next at why a lot of those smaller companies are basically being affected differently than some of these larger companies, and go a little more in depth than what I've seen people do kind of here on YouTube of why I think those companies are affected and some of the kind of the fundamentals behind that. So as we all know, the biggest news that's kind of been surrounding the market right now is interest rates. So where are interest rates going and how does that really affect the market? So what we're looking at here is, and I just picked AT&T stock, and I'm just using an arbitrary number of $1,000. Obviously AT&T has a lot higher debt than that, but basically, right, you have a bunch of investors right here. I have Doug, Sally, and Joe, and they're all trying to predict where interest rates are going to be at by the end of the year, over the next kind of couple years. They all have different time frames that they're kind of looking at. And really what's ending up happening is, right, they're all predicting different numbers. And these are again are just projected rates. So they might be projecting a 0.25%, they might be projecting a 0.5%, they might be projecting 0.75%, different interest rate hikes. And that obviously affects a company's debt. So in AT&T's case, if we're saying they have $1,000 in debt, right, their new debt over the year, right, because the interest rate is obviously going to affect how they borrow money and how their money basically is charged interest against. So what you have in there, right, is numbers in here where it looks arbitrarily small, right? So you're seeing $1,000, $1,002.50, $1,005, and then $1,007.50. But if you exponentially make those numbers larger, right? So if we actually multiply all those numbers by 1,000,000 and get a number that's more realistic for where AT&T's debt is at, then you can see that the difference between Doug and Joe's prediction is actually $5 million, which is a huge amount of money, right? That could be different growth projects that AT&T puts their money into, different companies that they basically try to acquire, and things like that. So that has a huge effect on basically how they're predicting that the stock price is going to react, right? And how much money they're going to have on their balance sheet, everything like that. So overall, right, Doug, Sally, and Joe, the average investor is not going to make predictions like that, and they're not going to take the time to do the math like that. So really, Doug, Sally, and Joe are probably more likely hedge funds and large basically investment funds that are trying to predict things like that, and they're trying to predict it before anyone else. So they have billions and billions of dollars under management, and they might make a play and say, okay, well, we're thinking the interest rate's going to be at 0.25%. So with that, the stock actually requires or has a intrinsic value of, let's say, $20 or something. So AT&T stock that's at around $25, right? They might say, well, let's sell it now, wait for it to go down to $20, and then buy in at basically below what our projected value is at, like $19. So that's affecting all this. And obviously, if Doug, right, predicts that it's a 0.25% interest rate, right, his value projection for AT&T is going to be vastly different than Joe's, right? If Joe says that it's a higher interest rate, right, he's going to say that the stock is actually worth less money. So as they're making these predictions, right, they're selling off shares. And really what that ends up happening is you end up getting this retail basically crew in, right? And I'm part of the retail crew, and there's no offense, obviously, no hard feelings towards that. But at the end of the day, right, retail investors tend to, I'd say, make the least educated decisions. Whether it's educated by things that actually come true or not, that's beside the point. But basically, they're going to have a more emotional reaction, right? So if they bought the stock, if they bought AT&T at $25, and all of a sudden, big hedge fund Joe is basically selling out of the stock billions of dollars, and the stock's plummeting basically down to that $20 mark, the retail investor might jump in and basically sell off as well and basically drive the stock down. And we're talking about millions and millions of retail investors, right? So now if they all own a few shares, then you've got millions and millions of shares that are all basically being sold off at the same time, which drives the price down even more. And where, right, if everyone knew what was going on in the market, everyone knew, let's say Sally was actually right, that it was going to be 0.50, we would have a perfect market, and basically everybody would know what the price should be at, and they would just sell down to that value. Let's say Sally had a projection of it should actually be at $21, and basically, right, then the whole market would sell off to that value. But you get a lot of these discrepancies because people don't know this information. There's differences, right, in what people are predicting. There's differences in the timeline that they predict these happens. And then there's also just investors that are making emotional decisions. So this presents a great, basically, buying opportunity that, again, we're going to get into here in a minute and kind of see why you probably need to look at your thinking and maybe potentially make adjustments to it. But the last thing I wanted to talk about here real quick is the difference, right, between an Apple, AT&T, and SoFi. So each company is going to react differently, right? So Apple has basically medium, I would say, growth projections, right? They still have the ability to grow. They've kind of consistently shown that over time, but they're not going to have some sort of like Tesla move over the last couple of years where Tesla's shot up, thousands of percent just over a couple of years. They're not going to have that type of growth. AT&T is low growth, right? It's been around forever. It doesn't have a lot of positive, like really big positive things kind of going forward for it. It's just kind of there, kind of chugging along. SoFi, I just picked SoFi. You could pick any stock. You could pick Hood, a lot of different stocks, but they have a lot more potential for high growth opportunities, right? Whether it's acquiring new companies. I mean, they already have lower valuations, so you can kind of see that the sky is the limit, right? If you compared SoFi to something like JP Morgan, right, their market cap is insignificant, right? They could probably 10x plus just to get even close to where JP Morgan is, So overall, that's something that you have to consider, right? Because the growth overall, you're going to see higher growth companies are naturally going to be affected by higher interest rates, because to fund that growth, they need money. And they have to borrow that money, and the higher they're going to have to pay to borrow that money, right, the less they can basically reinvest into their business, right? So SoFi might have to put off investing into new bank charters or whatever. I just pulled that out randomly, but whatever type of growth they're kind of targeting, right, they might have to put certain things off for a year or 2 years because they know that they can't afford it with their current things that they're focusing on. So that has a huge impact on it. And then the other thing is that I have here is debt, right? So a company like Apple, right, they're holding up the market, but they don't have basically any debt. So here I did large BS, that just means balance sheet. So Apple has a huge balance sheet. So they have money that they can pull from. Basically, if they don't want to pay interest on whatever loan they need, then they don't have to. They can pull off their balance sheet. They can basically use money that they have kind of sitting on the sidelines and use that to invest. A lot of companies, right, they'll still use debt because the interest rate is still low compared to previous time periods, right? We're still in a period of low interest in terms of, like, if you look at the 80s where numbers got ridiculously high, of well over 10% interest rates. So Overall, right, a company like Apple, though, they have the flexibility in there. So they're going to be less affected by interest rates. AT&T will be affected by it, but for a different reason than SoFi. AT&T has a large debt load, right? So as interest rates increase, basically their payments towards their interest, the money that they borrowed is going to get more and more expensive, and that's going to have a huge effect on basically how much money they have on their balance sheet, whether they can pay dividends, whether they can invest money into growth, whatever it may be. And then SoFi is in a similar situation where they have large debt compared to how the business is set up. They do have cash on their balance sheet and things like that, but overall they need that cash to fund their growth. So they will have to end up basically taking on debt to fund their growth. So overall, that's kind of a look at three different industries, three different kind of stocks that all are going to be affected differently based off how interest rates kind of progress over time. The last thing I wanted to talk about here is this man, and this man is Peter Lynch, and he ran the most successful mutual fund in the world called the Magellan Fund. And if we jump over here to Wikipedia, we can see that Peter Lynch took the reins in 1977 and ran the Magellan Fund for 13 years. So from 1977, from 1990, he ran the fund. It was the best mutual fund in the world, returning 29% annually. And that is absolutely huge. Warren Buffett, I believe, is somewhere around 20%. He actually he's done it over a longer period of time, which it makes it slightly more impressive than Peter Lynch. That's why Warren Buffett gets a little more kind of recognition for that. But in more recent years, Warren Buffett's kind of fallen off a little bit just because of the size of his fund. But beside the point, Peter Lynch kind of has been very, very successful and was very, very successful in the market over a long period of time. 13 years is a huge period of time. Just looking at the past 3 years, like think about all the volatility, all the things that we've had going on. He did it over 13 years, which is very, very impressive. But what's crazy is when you look at this here. So this is talking about the Magellan Fund, and the average investor in the fund actually lost money. Yeah, that's crazy, right? So the average investor lost money in the Magellan Fund, even though this guy, Peter Lynch, was returning 29% annually. And the reason for that, right, is because a lot of these investors, they see things going wrong, right? They see the market going down, and first thing that they think is, oh crap, it could go down further. Let me sell my stocks and try and buy back in when it's lower, right? So all these people are trying to basically time the market, and that is not how you play the game. That is not how you play the game, right? If you even think of more recently, right, Cathie Wood would be a great example of someone who I think will be successful, probably long term, but even in the short term, right, she's been fairly successful. If you look at Tesla, she bought into Tesla when everyone else was against Tesla, right? Back in 2018, 2019, when everyone was still kind of against Tesla, things were starting to turn a corner, and she was buying into the stock, right? And that's how she kind of built her legacy. And now she bought into a bunch of stocks that were kind of high and already ran up, and she's kind of suffering from it. But overall, right, these people who are successful, Peter Lynch, Cathie Wood, Warren Buffett, they all have a train of thought that is contrarian, which is basically saying that they think the opposite of, try and think of the opposite of basically what everyone else is doing. So if everyone else is selling, they're buying. If everyone else is buying, they're lowering their positions. They're trying to basically get out, right? Cathie Wood, this is something that I've kind of heard recently. She is actually buying into Tesla, or was buying into Tesla when it was in the 800, 900 range. When over the last kind of 6 months, she's actually been trimming her position. And now just recently, she's actually been basically buying more Tesla. And that just goes to show you, right, that the biggest thing, the best thing you can do is try and think of basically what is the opposite of what everyone else is doing. And overall, you're going to have a lot of success doing that. Obviously, none of this is financial advice. Kind of do your own due diligence, kind of look at stocks, see what you have faith in for the long term, and basically try and stomach some of those losses. Don't gamble with money that you can't afford to lose. and basically try and just hold on for the long term, right? Have kind of diamond hands or whatever you want to call it, and hold on for the long term, and basically pick stocks that you believe in for the long term, right? Don't pick a stock just because you think it's going to go up over the next week or next month. So overall, I hope you guys enjoyed the video. Like I said, I personally think that is a huge message that isn't put out there. I think there's a lot of negative videos that go on YouTube and whatnot that kind of just show the negative and put a lot of fear in people's hands. But the market, eventually, it'll bounce back, you know? And don't put more money than you're willing to lose in a certain stock, especially if you're picking individual stocks, you know? So keep those things in mind, and kind of just keep those in your mind moving forward, right? Because we could keep seeing a lot of volatility in the market over the next kind of few weeks or months as people kind of price in where interest rates are going to go. But over the long term, you know, if you pick stocks that you believe in, and your thesis works out, you're going to be successful, and you're going to be very, very successful. So I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Thanks, guys.